in the next few weeks, you're going to see the peak of inflation. You'll see inflation start to tick down on the margin. It's not going to be 8% to 3%. It might be from 8% to 7%, 6% over the next few months. But the most pronounced decline is going to occur in growth. Growth is going to plummet. Now, Q4 2021, GDP was 6.9%. We're going to have a one handle in front of this quarter now, Q1 22. And how am I so sure? What makes me think that? I don't just look at the Atlanta Fed GDP now. We have just gone over the biggest fiscal cliff ever in the history, all the way back to World War II. We've never seen a fiscal cliff like this before. So you stopped handing, no more enhanced unemployment, no more expanded child tax credits, no more stimulus checks, no more, mortgage forbearance has ended. So all these things were the equivalent of $50,000 for the average American family. I didn't get anything, but the average American family got $50,000 over the last 2 years. That already ended. So the economy is rapidly slowing. And you can evidence that by the Atlanta Fed's own prediction. It's a 1% handle in GDP. Okay. But then you're just now starting to touch the edge of that monetary cliff, which is going to be very unusual in nature. Not only is the Fed going to raise interest rates, they're going to raise interest rates at the same time they destroy money supply at the fastest clip ever. But this is the unusual part, Jay. They're doing so because inflation is at an all-time record high if you measured it appropriately.
Sure.
20%. But they're doing this as the economy is slowing.
Yeah.
They usually start tightening monetary policy when the economy is white hot.
Yeah.
And they're trying to slow down. But earnings growth, for example, earnings growth is going to go from 45% in 2021 to around 5% this year. That's a sharp slowdown in earnings. I just mentioned GDP growth already slowing down, and the Fed is tightening into that. And that's the major message you get from the yield curve. The yield curve has already inverted. It was sharply inverted as of yesterday, the 10s minus 2s.
Yeah.
Let me ask you a question, Jay. Do you know how many rate hikes it usually takes to get the yield curve to invert?
No, I don't.
It takes a lot. So the last time the Fed inverted the yield curve, which is 2000, well, I won't talk about 2019 because we'll just say, the yield curve predictor, which inverted in late 2019, just got lucky.
Sure.
Because it didn't know about the pandemic. Let's just excuse that. Let's go back to 2007. Yield curve inverts in 2007, and it took 350 basis points more of rate hikes to invert the yield curve. This time, the yield curve inverted after one lousy, measly, puny 25 basis point rate hike. And the reason why it took only one rate hike to invert the yield curve is because the economy is so weak, it cannot withstand 350 basis point of rate hikes. But they're going to have to do it anyway to get inflation under control. Do you see the problem? Have I laid out the problem clearly enough for you? And it's not just a problem. Like let's just say the Fed funds rate was already 2.5, and the Fed's balance sheet wasn't 9 trillion; it was 5 trillion, and inflation was 4% instead of 9%. Well, then I could tell you, the Fed's going to have no problem. They could just stop. But none of those things are the case. The Fed has to attack this inflation, as I very clearly laid out for you. But they can't do it with impunity. They cannot do it innocuously. They cannot engender a soft landing because they have to tighten now into a very weak economy as opposed to one that's very strong. That he won't be able to consummate his rate hiking plan, which takes the Fed funds rate to 3%, 2.5 to 3%. But he will pursue that goal until inflation is 3% or the credit markets freeze over. I'm betting that the credit markets freeze over way before inflation hits 3%. We're in sector 2 of my 5-sector spectrum that runs between deflation and stagflation. Sector 2 is when you want to own disinflationary assets. So think about bond and bond-like proxies. So you think about utilities. Think about stocks like Walmart, for example. You also want to take a lot of short duration assets because, as we just laid out very clearly, the Federal Reserve has already explained to the market that they're going to raise the Fed funds rate to 2.5% to 3%. Well, that's already reflected very clearly in 1 to 3 year treasuries. So they're already pricing in a Fed that can raise, 10 times. And if that's already priced in, and I'm telling you they'll never get to 10 rate hikes, you want to own short duration bonds. We have been long the US dollar now for quite some time and profiting very nicely. So the answer is you want to own assets that are either bond or bond-like proxies because the peak of inflation is here and the peak of growth is in the rearview mirror and it's about to crash. So we have some shorts in the portfolio. We've avoided and we sold everything that's cyclical, everything that's high beta, everything that doesn't, think about companies that have promise of earnings decades in the future. So think about the disruptors. Out and short those things is what you should have already been.
Interesting.
Their pain, in my opinion, is just beginning. Think about utilities. Walmart pays a nice dividend. It's a great stock to own as a hedge against an economy that's headed into recession. But eventually, Jay, you're going to want to own, and I'll leave this timing for me and my clients, because my model will let me know, hopefully, well in advance, at least a few weeks in advance, when we enter what I call the liquidity crisis zone, which is where Powell will shift gears.
Okay.
Now Powell's not going to go, I just want to say this, Jerome Powell's not going to go from destroying $100 billion a month in treasuries and mortgage-backed securities to buying $100 billion a month. It's going to take some time before the Fed moves that quickly. It's like moving an aircraft carrier at the FOMC. So what I'm saying is there's going to come a time when you're going to want to own only the 4 horsemen of what I call the economic apocalypse. And they are long the US dollar, lots of cash, sovereign bonds, and shorts. Those are the only 4 things you're going to want to own. 4. And if you own those 4 things as the liquidity crisis occurs, you'll probably, I can't guarantee it, of course, but given the history of those 4 things, you're probably going to do a very good job of protecting and profiting from the decline. Forget about losing 30 to 50% of your assets. You might even do well during those times because the correlations, the R squareds go to 1 during a liquidity crisis. Everything gets dumped at the same time. I don't care if you own Apple or if you want to own Amazon or Microsoft or growth versus, value, all that BS goes down the toilet. It's all 1. ETFs get dumped and every single equity in the ETF gets dumped because people need one thing. They need one thing. They need liquidity. What's liquidity? Dollars.
Yeah.
That's what they need. And that's what they'll get. They'll even dump gold for a time. Yeah. But I think, by the way, if they do indeed dump gold, miners will do worse than physical gold, I'll tell you, because miners are stuck.